AI-linked equities have just delivered their strongest quarter since the pandemic, even as the dollar stays firm. Rate paths remain uncertain and tensions in the Middle East cloud the oil outlook. That divergence between buoyant risk assets and unresolved macro and geopolitical risks is the backdrop for today's cross-asset picture. This is VTalk Insight, Allocators Lens Daily for July 1st, 2026. We will connect equities, rates, credit, currencies, and commodities through an allocator's lens. Let us start with equities, where the AI build-out is reshaping both earnings and risk. In equities, AI-linked growth is still doing the heavy lifting. The S&P 500 has just logged its strongest quarter since 2020, with total returns approaching 19%, while semiconductor shares have delivered their best quarter on record. Asian markets echo that pattern, with tech-led gains giving the region its strongest performance in more than a decade. Underpinning that strength, earnings expectations keep grinding higher. Forecast profit for the index has been revised up from around $320 to the mid-330s, and forward price to earnings multiples now sit near their 40th percentile. Massive AI-related capital expenditure, with projections into the trillions and large backlogs at hyperscalers, reinforces that profit story. Market leadership is still concentrated in big AI beneficiaries, but breadth is quietly improving. Equal-weighted technology indices have outpaced the mega-cap complex, while emerging markets and small caps have begun to outperform. Momentum strategies have returned more than 40% this quarter, and retail flows are buying dips in chip names and broad exchange-traded funds. Against that optimism sit several equity risks. Index performance is dominated by a group of AI champions, from mega-cap platforms to Korean memory leaders, leaving benchmarks exposed to any reversal in a handful of names. Questions are mounting over whether AI CAPEX can be monetized, whether it adds to inflation, and how profits would withstand cyber shocks or another banking scare. In rates, the key question is whether central banks are really done. Market pricing still gives roughly a two-thirds chance of another United States hike by September, yet short-term inflation measures have rolled over. Two-year break-evens have dropped from around 3.4 to near 2%, and wage and productivity trends now look more consistent with inflation moving back toward target. Against that backdrop, the Federal Reserve is widely seen waiting at least another quarter before contemplating new moves, helped by a recent court ruling that reinforced its institutional independence. Policymakers are leaning away from rigid forward guidance, and both the European Central Bank and Bank of England now emphasize meeting-by-meeting decisions, even as they leave the door open to further tightening if inflation reaccelerates. On the curve, that uncertainty is driving a preference for shorter maturities. Two-year United States yields have risen sharply over recent quarters, and flows this year have favored ultra-short bond funds and income-focused exchange-traded vehicles, while long-duration products see outflows. At the same time, Treasury supply is projected to grow dramatically, prompting structural reforms such as broader central clearing to help keep market liquidity resilient. In credit, conditions still look benign on the surface. Corporate borrowers have issued about $1.1 trillion so far this year, on track for a record, with large technology groups funding AI investment through substantial bond deals. June's investment-grade wave was absorbed smoothly, and spreads remain contained, suggesting strong demand for high-quality income. Beneath that, several structural vulnerabilities are building. Equities and corporate bonds are trading with unusually high correlation, reducing diversification benefits, while more long-term financing has migrated from banks to leveraged non-bank investors. Global debt levels are edging toward 100% of economic output, and shifts in positioning by a concentrated group of intermediaries could amplify any future shock. Within financials, analysts have turned more cautious on big banks, highlighting leverage and the risk of another downturn in the sector, while alternative asset managers and private credit platforms attract growing allocations from sovereign wealth funds. At the same time, official institutions warn that AI-enabled cyber attacks represent a rising threat to financial stability, making credit spreads and funding markets important barometers if volatility were to return. In currencies, policy divergence is clearest in the dollar-yen pair. The yen has weakened to levels last seen in the mid-1980s, driven by wide rate differentials, a firm dollar or Japan's reliance on dollar-priced oil. Authorities signal discomfort but have avoided aggressive intervention, even as imported inflation raises questions about how long current Bank of Japan settings can persist. More broadly, a stronger dollar supported by recent Federal Reserve hawkishness is pressuring other Asian currencies and has helped trigger foreign selling of Korean equities. Some research warns that an additional sharp dollar rally could become a major pain trade, while digital assets are already flashing caution. Bitcoin exchange-traded funds have seen over $4 billion of outflows this month as prominent corporate holders turn into net sellers. In commodities, oil remains the main transmission channel from geopolitics to portfolios. Iran has tightened its effective control over the Strait of Hormuz, floated the idea of tolls, and engaged in skirmishes that keep ship owners and insurers cautious, even as negotiations on nuclear and sanctions issues deliver only a vague memorandum. Yet spot prices have fallen toward the low 70s, and major banks now project roughly $70 to $75 over coming years on the back of strong United States supply and softer Chinese demand. Looking further out, forecasts of a sizable crude surplus around 2027 may prove too pessimistic if big importers, such as China and India, rebuild strategic reserves, which could limit downside for prices. For energy importing economies, the risk is that even moderately higher oil and gas prices, combined with Europe's already high electricity costs, keep inflation elevated and weigh on competitiveness, while industrial metals like copper gain importance as strategic inputs to AI infrastructure and electrification. Stepping back across assets, the picture is one of powerful AI-driven equity momentum running alongside a still uncertain rate path, tight but increasingly fragile credit, a firm dollar with a vulnerable yen, and an oil market torn between supply normalization and persistent geopolitical stress. Key questions for months ahead are whether earnings can keep outrunning higher real yields, whether credit and liquidity remain available if volatility returns, and how quickly any new energy shock or dollar spike would feed back into inflation expectations and central bank thinking. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @VTalkInsight. Alternatively, visit vtalkinsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.